Hello everyone, I hope you are having a wonderful week. Welcome back. Today we are going to talk about restricted stock units. If you work for Amazon or Microsoft or any number of other tech companies, you likely have restricted stock units as part of your compensation package. So as RSUs are part of your compensation, when you receive the shares, when they're vested, the value of those shares is included in your wages. Normally, some of those shares are sold at the time of vest in order to cover all the taxes that are due on that share vest. So it'll cover the Social Security tax, Medicare tax, and some federal withholding. Let's take a quick detour to talk about withholding, because often the default when they do this calculation to sell to cover, they're using the 22% bonus withholding tax rate. So the problem with that is that you may be in the 32% bracket or the 35% bracket, meaning if they only withheld 22%, but your new dollars, your additional income on top of your wages is being taxed at 32 or 35%, you haven't paid in enough and you're accumulating a tax bill to be paid next April. So most companies do allow you to choose what rate you'd like to use. And this is one of those places that I wish that there was a good rule of thumb to tell you of what rate to use. Unfortunately, there isn't. And all I can really say is that we recommend working with a tax professional that has your pay stubs, your full information to be able to calculate for you what the best rate is. If you choose to just use that bonus rate of 22%, you may have that balance due come tax time next year. If you choose, hey, just use the highest possible tax rate, use 37%. That's fine, but you may have just given the government an interest-free loan until tax time next year, and you may have sold more shares in order to cover that tax than you really wanted to sell for that. So definitely considerations, pros and cons on both sides, but this is definitely a place where we'd recommend talking to a tax pro. So back to how to report these RSUs on your tax return. As we talked about, the value of these shares is already included in your W-2, so there's nothing special you need to do with that. However, the shares that they sold to cover the taxes will be reported to you on a 1099. The IRS got a copy of that as well. That share sale has to be reported on the tax return as a capital gain or loss. With that, it is not going to be a profit. You sold the shares for the same value as you received them for, as you're paying tax on them already for in your wages. So generally these transactions look like if you had $100 worth of stock, it will show $100 in sales proceeds, and it will show $120, $110, something like that in cost, because there were some fees related. So it's usually just a very small loss. Note that if you do not report that 1099 on the tax return, that is one way to get an Insta letter from the IRS assessing you tax that you don't owe. So save yourself some stress. Make sure that 1099 gets reported on your return. One myth is that it is always best to sell shares that have been held over a year in order to pay the lower capital gains rate on those shares. And while, yes, that's true if we're talking about two different lots of stock that have the same amount of profit, that yes, you'd want to pay a maximum of 15 or 20% tax on that profit rather than pay your 35, 37% max rate at the personal level. However, if you are looking to sell some of your shares, you're trying to free up cash, you're trying to diversify something, you're going to sell some RSU shares, you're already paying tax on the value of the shares that you're vesting today. So selling those particular shares will create no additional tax implication, whereas holding those shares and selling some of your older shares is going to add to your tax burden for this particular year. So let's just look at that for a second. Let's just say you have $100,000 in wages, you are vesting $60,000 in RSUs this year. We're going to just ignore that some of those will be sold to cover. And then let's say you have $50,000 worth of long-term stock and about half of that is profit. So if we look at that and think, okay, my baseline tax situation, I sell nothing, I'm going to have income reported to the IRS of $160,000. It's the $100,000 in wages that plus the $60,000 in RSU value, which is all going to be reported on my W-2. Total income reported to the IRS is $160,000. Now, if I sell all of that $60,000 in RSUs that I'm vesting this year, those numbers don't change. You're still reporting the $160,000 that was reported on your W-2. You have no profit from stock because those shares didn't go up in value between the time that you received them and the time that you sold them. So you're still just reporting $160,000 in income to the IRS, and yet you have that cash in your pocket that you sold all of the shares. If you sold instead, you held those vested RSUs and you sold the old ones, well, now you're still reporting the same $160,000 in wages, but you're also reporting $25,000 in profit. So you're reporting $185,000 in income to the IRS. So you can do that, but your tax situation is going to be better if you sell those short-term shares. You may also want to look for shares that perhaps have decreased in value or have a minimal profit rather than those long-term shares that may be substantially profit. So does this help? Did I tackle all of your questions? Is there anything else you wanted to know about RSUs? Definitely let me know in the comments or drop me an email. Subscribe. Let me know what you think we should tackle next week, and have a fantastic week. Bye.